Hi, everyone, and thanks for coming along to our Q4 2021 fund recap and market what goes up must come down update. Uh, just looking at these two pictures on the side, I thought they were pretty indicative of where we stand right now in the markets. Markets are completely disjointed and disconnected from anything fundamental or economic reality based. And so there will be a comeuppance at some point here, but let's get into seeing the when and where that might happen. So, of course, of late, everything's been about inflation over this last year. With inflation soaring out of control, this has all been created and manufactured, with or without intentions by the Federal Reserve and their egregious amounts of money printing that they've been engaged in, not just since the COVID crash, but since the bottom of the markets back in 2009. So right here, this is the goods inflation, which has soared 10.7% year over year, and now it's at its highest since 1975, going all the way back, through the peaks in the 80s as well, back to 75. The next chart shows us the consumer price index, which similarly is now, given that it's at 7%, is now running back through the 80s and all the way back to the earliest that it hit this level was back in 1975 as well. In addition to that, looking at the producer price index, both the intermediate and final demand, what this is showing is that this is the highest PPI intermediate measurement since December 1974. And as a context for that, at that time, the US had mile-long lines for gas. So, thinking about people's concerns of shortages of things in the grocery store. Are we going to have another energy crisis as a result of all this inflation? Well, are things going to be impacted? I guess time will tell. But if history is any indicator, and if we're supposed to learn from history, then maybe that's something we should keep on the radar and be prepared for as time moves forward. So, looking across the broader context of inflation, just here are some of your basic goods and necessities and things that people either need to purchase or have to purchase. Your foods, your rents, furniture, cars. Some of these things are incidentals that are more of luxuries as opposed to necessities, but still it gives you an idea of the types of inflation that we've seen in different areas from November 2020 at the last election up until November of this past year. We're being hit all across the board, across every spectrum of life. Inflation has been increasing, and in some areas, very dramatically. Now, all that being said, if we take a look at the University of Michigan Economic Confidence Index, you'll see this was the crash over here to the right-hand side was the crash in March of 2020, and you'll see that the economic confidence today is actually less or lower than where it was in March of 2020. And remember, we are still at 0% interest rates right here. But what is interesting is you'll see that each time the Fed has raised rates, it's led to problems in the economic confidence and just in the economy in general, let alone markets and asset prices. You'll see each time here, each of the blue lines is where they raised rates, and especially here, going back across these last two periods, really had a dramatic effect on the economic confidence. But the point of the story is, like I said, we're still at 0% interest rates, and the economic confidence is worse than March 2020. What does that bode for in the future? Time will tell. Now, with all that going on and the lack of economic confidence, juxtaposition to that, we see the S&P stock market, which has taken off to astronomical levels. And remember, this is all during the COVID years. This has been the hottest stock market in all of history, because that makes sense, right? With all the problems and issues and everything else going on out there, why and how did the stock market take off as it did during such a pandemic and an economic shutdown that we've been through? leave aside all the punditry from Wall Street that is the continuous, bullish sell side mantra of buy every dip and everything's going to be wonderful forever and ever, until it's not. So digging deeper into the S&P, never so much owed by so many to so few. And this is the S&P 5 by 5 by 5. So going back to 1990, this is your top 5 stocks rebalanced monthly. They are up 5 times over the past 5 years. Big is beautiful, apparently. Or is it just big bubbles are beautiful until they burst? But this is the dot-com bubble compared to where we are today. Sort of puts things in perspective, right? So moving on, given that the S&P is at these all-time highs, it stands to be considered that with stocks ending 2021 at the most expensive level ever this is the S&P 500 price to sales comparative chart. And looking back, you'll see that when we hit the highs back in the dot-com crisis, moving forward, you'll see this, this was probably 2018, January 2018, and this was the crash into Christmas when the Fed about faced with their interest rates and things took off into 2020, and then the COVID crash, and then they added $3 trillion of money printed out of thin air on the magic money printing machine that the Federal Reserve has at its disposal, and has created now the biggest bubble in all of history. And just remember, this is a bubble in everything. It's the mother of all bubbles because it stocks, bonds, real estate, corporation values, everything under the sun, and also debt, if anyone's been paying attention to that. So looking at a different measure of valuations, this is the, Robert Shiller. He was the person who famously called the real estate bubble in 2007. But this is his CAPE index. This period here was 1929. This was the dot-com bubble, and this is his measure of valuations as of today. So we're getting very close to where the dot-com bubble valuation were based on this metric. And when you look at a more, an old tried and true measure of valuations, everyone calls the Oracle of Omaha, Warren Buffett, is sort of the granddaddy of the stock market. And this is the Buffett indicator showing where valuations are historically going back to 1990. And you'll see we are right at the same levels as everything was in the dot-com bubble. So, at these levels in markets, buyer beware, or even buy and hold investor beware, which obviously, as you all know, is not what we do. We buy, hold, and sell to mitigate downside losses in the markets. But hey, once again, we're at these inflection points, and time will tell, and we'll see where things go. With inflation raging out of control, the Fed is gonna have to start raising rates to try and fight inflation and get it under control. And in doing so, they will cause problems in asset prices. So we'll see if this is that inflection point, to a T of the dot-com bubble. So what this shows, and what has exacerbated this massive run-up in stocks, is not just the fact that the Fed has been adding liquidity, quote unquote, through all the money they've been printing, but when looking at margin debt. So margin is where people have their stock portfolios, they borrow more money from their broker dealer or their whatever Wall Street firm they've got their assets housed at, and they borrow more money, i.e. debt, against their current stock portfolio to buy even more stock. So it's leveraging up their stock portfolio, which is great on the upside, but it works just as well on the downside too. You had the dot-com bubble, you had the 2007 bubble running into the 2018 tantrum down into 2020, and then everything's just exploded higher. Why? Because it's all at the explicit behest of the central bank put, or the Powell put, as everyone's been calling it, because traders believe that nothing ever really bad can happen. No one's really going to lose money over the long term because the Federal Reserve will always jump in and stick save the markets and push things ever, ever higher. Amen. Until they get to a point where we're nudging up on hyperinflation and a Weimar Germany experience, and they really have to get that under control. And so are we, once again, are we at that point where all this irrational exuberance is now going to lead into a period of decline and underperformance, along the lines of the 1930s depression after what happened in the 1929 blow off top? Markets did not have a V-shaped recovery when that bubble burst, and I'm expecting the same as we move forward and things have to ratchet back down to real economic fundamentals. Modern monetary theory is what has created, the thought that you can just print money endlessly and only good things will happen. Well, that's being proven false on its face value as we speak today, and we're seeing all this inflation that's out of control. So, all this debt that's been built up, it has to come flooding back out of the system at some point. So imagine what that does to stocks and asset prices, right? Now, with all this, you've had the S&P stocks running higher. Remember, stocks are not the economy. When you look at the actual economy or the Citi US Macro Surprise Index, so this is the economic surprise index, it has been declining. Yeah, this is through late 2020 and then down through 21. And through all this surprise underperformance or negative surprises, as they say, stocks have just continued powering higher and higher. Well, how can that possibly be if the economy hasn't been grinding higher and higher? Well, the simple answer, once again, is central banks. Because when you look at the S&P 500 index superimposed over the global central bank balance sheet, the two have worked in tandem, tick for tick for tick. So understand, when the central banks of the world print money out of thin air and they turn around and buy bonds and mortgage-backed securities, corporate bonds directly from the companies themselves, which, by the way, is illegal and against their purview. But hey, if no one calls them on it, then why not? They've been buying bonds directly in markets, directly from corporates themselves. I fully expect after the next big conundrum and crash and crisis that the central bank will announce they're going to start buying individual stocks and stock ETFs, just like the Bank of Japan has been doing for years and years and years. So, but in the meantime, this is the reason why markets have gone high, because as they've bought up all these assets, their balance sheets have increased. So that's does causation equal outcome, if that's the right saying? I don't know. I'm just looking at Occam's razor. The simplest answer generally is the correct answer, and that's what I see in this chart. So finally, looking at the price to earnings ratio of the 10 largest stocks in the US. Here we are, the dot-com bubble. Here we are today at the beginning of 2022. We're right back at those same historic levels. Is this the inflection point? Have we, from a technical analysis standpoint, markets and movements in valuations and such do adhere a lot of times to technical levels. And it's pretty interesting that right now, this one has basically hit exactly where it was in the dot-com bubble. But yeah, we'll see where we go from here. But if you're buying at these levels up here, I don't know who you're listening to. Maybe you're listening to Wall Street, your big broker-dealer firms who are saying that when's it a good time to buy a house? It's always a good time to buy a house. Same thing in the stock market, obviously. How overvalued is the market? Doesn't matter. It's always a good time to buy stocks. Well, yep, everything works until it doesn't, or everything's fine until it's not. The question is, when does that flitch and that turn occur in markets? So moving on from the things that are hot on people's minds right now, inflation and such, and the eventual interest rate hikes and also balance sheet reductions that will be coming at some point. Moving on, just looking at some of our different funds that we have on offer. We are up to 11 fund models that we offer on our platform for clients and investors. So first off is our Total Return Income Fund. This is a conservative-based income fund model with half stocks, half bonds, mainly US focused, high dividend yielding. And this one was started back in August 1st of 2017. So And we do compare against the equal weight US market index, which is the Value Line Geometric Composite Index, and it's 1,700 companies that are broadly diversified and equally weighted across the North American markets. And this does represent what your average investor's portfolio performance would do, because Wall Street always recommends your average investor should be broadly diversified and equally weighted. So hence, all we're doing is we're showing what our funds can do compared to 95% of all the people out there. That's your financial advisors, financial planners, and people who do their investing for themselves under that buy and hold mantra of Wall Street. And the difference, what we do, is to mitigate and protect from the downturns and losses that have, do, and will again occur in the markets. So head to head, our conservative fund has basically done the exact same as what the broad equal weight US markets have done over this 4-year period, 4.5-year period. Moving on, our moderate fund, the Global Opportunity Fund, this is 25% stocks and bonds in the US, and then the other 50% is international markets, both developed and emerging and frontier. Now, the US markets have obviously been a one-way street higher over these 9 years, or longer, I should say, 13 years, I guess now. But the international markets, if you've looked at any long-term charts, they've really just sort of been this meandering sideways churn. And effectively, the reason for that being is that the US markets have been the cleanest dirty shirt in the hamper, because we have marginally positive real interest rates here as compared to negative interest rates in Europe, because of the massive amounts of bond buying and stimulus they're doing there, and places like Japan where interest rates are negative by policy decree. So given a positive rate of return on your cash, where do you think monies from around the world are going to flow to? Right into the US and US markets, which has also exacerbated what the US stock market has done, because of all the international capital flows as well. Because their own markets have just been floundering sideways for a long time. But anyway, that said, the moderate fund is underperforming the US markets by 8%. Now, looking at an apples to apples comparison, our 100% US equity fund, which is an aggressive model fund, these ones were started in August 1st of 2018. So this is really the prime example of what it is we aim to achieve with the underlying strategy that we run. This was 2018 crash into Christmas. This was the crash in March of 2020. And this is the rollover that's already occurring right now. So head to head, our US fund is beating US markets by 12%. That's the difference right here. But it's not about this. It's about this: preserving wealth and protecting capital. Because if we can avoid the losses in the first place, we don't have to waste time making losses back. And hence, that's how you, especially over the long term and full market cycles, you beat the markets by not losing. But you'll see, it wasn't just, we got lucky one time or lightning strikes twice. We're now proving out for a third time's the charm that the strategy works each and every time over the long term. Our second aggressive fund is the international equities markets, and same time frame since 2018, and it is exactly head to head with what the US markets have done over this period of time, right here. So some of the specialty funds that we've started to add over the recent couple of years, we have an S&P managed fund. So this is the only fund model that we compare against the S&P 500 index, because it is an apples to apples comparison. Now, we do use a triple leveraged S&P ETF for this fund exposure. So you'll see here, when we started out in January of this year, I should say, last year, well, we're already into January now, but you'll see that we didn't have to chase markets. When we did get in, you see how quickly the fund caught up to the actual S&P itself. It's because of that triple leverage exposure. Now, given where our overly valued markets are, we are simply waiting in cash for a larger drawdown and correction in the S&P to give us a nice entry point to get this fund invested, and then catch some upside growth. And remember, that upside growth will be 3 times what the S&P does. So, there's nothing wrong with being patient. Wall Street tells people you have to be invested at all times. Why? Why do you want to be invested when markets are dropping, for instance? Why wouldn't you want to be in cash and avoiding those losses? But, that's why we do things differently, and we have a different mentality and mindset about how we approach the management of the investment fund models that we offer. So another specialty fund we have is the Precious Metals Fund. We started right towards the end of the peak back in 2020. Precious metals had a massive run up, but we started this June 1st of 2020. We caught the last little end of that peak, and now there's been this consolidation phase that's been occurring in the precious metals space. But I am expecting precious metals to turn higher and adjust for inflation and massive amounts more. When we get into the next big financial crisis, the Fed is going to have to destroy the dollar in order to try and save everything. And so that can be a higher inflection for precious metals. Gold has also been an inflation hedge and a store of value for 5,000 years. And even just from the safety, a safe haven asset aspect, we get into an economic downturn or heading into recession or depression or whatever, gold's been a great store of value. So I see there's so many reasons for precious metals to go higher, let alone the Wall Street firms like Goldman Sachs calling for it's trading around 1,800 or something now. Goldman Sachs is calling for 2,200 on precious metals as their target. So even if you want to just believe not crazy old Corey, but maybe you just want to believe in the Wall Street firms themselves, then they say gold is going higher. So that's one of the areas of opportunity, I think. Bitcoin was another one that we started on June 1st of 2020. This is trading in one Bitcoin ETF. We're either 100% in or 100% out. We managed to capture pretty much the majority of the first spike that occurred into early 21, and then we had some pullback. But then on the second spike that occurred up into November, we didn't quite, there were some big moves where Bitcoin jumped, and by the time we got the buy trigger, then we had missed some big chunks of the upside move. But to the reverse of that, since then, Bitcoin and cryptos have just been dropping and going lower. So we missed some of the upside move, but we've also avoided a majority of the downside move. And of course, when you have a downward moving asset, it's extremely difficult to make money in a downward moving asset, even though you do get buy signals here and there to get in, and then it would just roll over and drop further. So at some point here, Bitcoin will bottom and sideways out, and we'll get into another upward trend. And the stock to flow model, you can Google search that on Google, but it indicates that Bitcoin should be up around the $100,000 price point per coin. So it's held true historically since Bitcoin was incepted. So why would it not continue to prove true, especially as there is more adoption and regulation and clarity provided for the entire Bitcoin and crypto space moving forward. Pardon me. Another crypto fund that we just started November 1st of last year, of this past year, was Ethereum. Similar situation. It's one position. We're either in the Ethereum ETF or we're in cash. And like I said, crypto peaked. We couldn't have picked a worse day or month to start a brand new crypto fund than right at the peak of this most recent market, because all cryptos have done since then have just declined lower and lower. So just like the Bitcoin fund, Ethereum has been, you see periods when we're just flatlined and we're in cash, and then we find a buy signal and we get in, and then it just rolls over. So there's not much that can be done with that. Just the fact that hold true that over the long term in full market cycles, the strategy will prove out and will win out over the long term, just as it has with all those other funds that have done so well that we showed before. Just understand, though, when you are in a highly volatile underlying investment asset or class, then there are bigger moves in both directions that make the fund itself inherently more volatile as opposed to, like, for example, the US fund, where the line was very, very smooth, but then again, it was also a longer time frame, which smooths out a lot of these, little bumps and gyrations. So moving on, we have a cannabis fund. This one we started in November of 2020, and of course, it took off, right out of the starting gates. And since February of this past year, same thing. It has just been this downward dog, just a continually deteriorating asset class. And so it's same thing. It's real difficult to make money in a downward moving asset, but you get a buy signal, you got to get in and hope things can continue in that upward trend. Unfortunately, it hasn't had that luck so far. However, at some point here, I firmly believe, as much as what happened in the elections back in November 2020, and there were so many more states and cities and such that were legalizing cannabis and marijuana, I firmly believe at some point here down the road, we will get a federal and national legalization of cannabis. And boy, howdy, I tell you, when that happens, this entire space is going to, in my mind, it's going to take off to the moon, because upon federal legalization, all the big alcohol, tobacco, and big pharmaceutical companies are going to swarm in and buy up all these mom and pop, quote unquote mom and pop. I understand some of these private companies are rather large, but still, they're all positioning themselves to try and gain market share to be a buyout option. Once that federal legalization comes, and when all that big corporate money comes swarming in to buy up these little private cannabis companies, that's really what this fund is about, is biding time and looking for that opportunity for that moonshot when it comes. And I firmly believe that that will come at some point, and hence that's all this fund is waiting for. And then finally, the commodities fund, which we also started November of 2020. And I started this one because back then, looking at comparative charts of where US stock prices were compared to the broad global commodity index, there was a massive, massive dislocation where stocks were extremely overvalued and commodities were extremely undervalued, because we've been in a period of deflation for number of years, ever since really the 2011 peak, after the first initial round of stimulus was shot at, from the lows in 2009. But there's been a long-term consolidation. I think that inflation is, as we're already seeing in all the indexes and such, it is just beginning to raise its ugly head. And so understanding that and looking for being a value investor, just from that pure standpoint, I don't understand why more people weren't looking to buy into commodities at such low levels. But we started this fund in November of 2020, and now it's up 28% compared to the equal weight US index that's done 34. But that's okay, because at some point here, things will roll and drop lower, and we'll look to lock in and hold on to gains. And then, once a correction has occurred and commodities turn to move higher, we'll jump right back in again to gain that next leg of upside momentum. Is obviously what we're trying to do. But, too many times Wall Street touts and sells different arenas and investment concepts, and they say, oh, look, commodities are up 30%. That's an area that you should be invested in. Well, I'm sorry. My view is that you should be invested into an asset before the performance occurs. Because when you're investing into commodities after it's already had a 30% rise, you've already missed that 30% increase. And chances are, by the time Wall Street's selling something and talking about it on the financial news, chances are the move has already occurred. And that's the time that you should be a little more cautious about different asset classes. That's just my thought in general. But if you pay attention to what they're telling you and what asset classes are doing, and then following what the moves occur in those asset classes moving forward, you'll get a better idea for yourself of exactly what the game is and how it's all played. So those are our 11 funds. And so stepping back again, looking at margin debt balances. So we removed that second line of the free cash flow. This is what has occurred. And this is why you hear people talk about, and openly talk about the bubble finance that we have moved into really since the 90s, and the dot-com crash, the financial crisis running up to 2018, up to today. We're just engaging in more and more and more leverage and debt, and relying on free money to create wealth rather than actual underlying economic fundamentals. So, that same chart put into different contexts. This is from Wolf Richter, who's an independent analyst out there. I'm sure you've seen him on news networks and stuff. But as he shows what some of these moves are in the S&P. From the dot-com bubble down, the S&P was down 50, Nasdaq 78. From 2007 to 2009, S&P was down 56. In February 16, S&P down 20. 2018, in December, into the Christmas crash, it was down 20. And now here we are. WTF? What the fuck? Pardon my French, but if we want to be real about things, that's the reality of where we stand. Which leaves us to, and throw on top of that the fact that we are now $30 trillion in debt as a nation. I mean, I've been telling people for years that when you really look at the debt explosion that's occurred, and it's at all levels. We are filled to the gills with debt at a national level, the corporate level, states, cities, local municipalities, families, and individuals, just across the spectrum. And if you take debt out of the equation and all the money printing, then we have zero economic growth. Without the debt that we've encumbered ourselves with, we would have no economic growth whatsoever. And that's a sad state of affairs of the reality of where this country is and this economy as a whole is, and hence the problems and issues that we're going to have to deal with as we move forward. And now think about all that debt and the fact that the Fed has to raise interest rates, and hence the cost of all that debt goes up as companies and everyone try to roll that into new debt. Anyway, interesting times ahead of us, to say the least. So, and here's a comparison of all the different countries around the world and what their debt to GDP ratios are. Venezuela, Sudan, Japan's just the nutcase of debt to GDP of a supposed developed nation. Greece, you've all heard, all the Eurozone problems. Greece is always the bad boy over there. The southern states of Europe, Lebanon. Hang on, what's this? The US is wedged right in here between Lebanon and Portugal as far as total debt to GDP. Now, when you put things in this context, then it makes you realize that the US maybe isn't as exceptional at doing things. Yes, we have a marginally better economy. And of course, remember, we do have the global world reserve currency, which is what enables us to live the luxurious lifestyle and low-cost items as compared to energy and everything else historically. But once again, we're sitting, our debt to GDP is on par with some of these other countries. So is it really our economic exceptionalism, or is it just debt like every other country around the world has been piling on to maintain some sense of financial stability? So, and speaking of the Fed having to raise rates, understand this: the Fed has a 1,000% batting average when it comes to raising rates. And what I mean is what's delineated on this chart. And as I said, here we go again. Don't fight the Fed. So remember when the stock market was going up and the Fed was being accommodative and easing and adding liquidity, and everyone said, don't fight the Fed, don't fight the Fed, because they're going to support the markets? Understand that every single time the Fed has gone on a rate hiking cycle, it has led to a drop, a crash, or a crisis every single time. That's what I mean by the Fed has 1,000% batting average. And now, is it going to be a recession or depression that we got to deal with because of all these egregious amounts of debt that we have to contend with inflation out of control, hence stagflation, which is a recession combined with out of control inflation, and gives us the likenings of the 1970s time frame. But too many people, I've already seen them likening today to 1929. And what followed? was the 1930s global depression to deal with all the excesses that they had back then. And personally, I feel that that is what we are honestly contending with from where we stand today. We got to have a global depression to deal with and wipe out and all this debt overhang that we have at all levels of life. So, like I said, interesting times ahead, to say the least. On top of that is not just the Fed hiking rates. Deutsche Bank, which forecasts that once QT begins, the Fed's balance sheet will shrink from 9 trillion currently to 6 trillion. That is a $3 trillion problem on our hands. Because remember, the Fed pumped $3 trillion into the stock market. Well, they say it was for the economy, but we all know it went directly into the stock market. And the better the stock market's doing, the better the economy's doing, because everyone feels wealthier and everyone spends more, and it's a self-fulfilling prophecy. Just like when people start talking about recession, people stop buying things, hence no one's selling anything, and the recession becomes a self-fulfilling endeavor as well. But this is a massive problem. Understanding that this created the bubble highs we have right now. What do you think happens when they start taking the magic, the punch bowl away and actually start draining money out of the stock market? So those are the predictions from Deutsche Bank of what's going to happen moving forward. Of course, we all know back here the Fed was supposed to reduce their balance sheet, and they started to marginally, and then there was problems in the repo market. And for anyone who says that a recession or a depression or problems cannot occur while the Fed is being easing and accommodative, well, during this period from late 2018 up into March of 2020, the Fed was easing and being accommodative, and the crash in March of 2020 still happened while the Fed was increasing their balance sheet. So is it actual reality that the Fed is manipulating the market, or is it simply the psychology of people believing that the Fed can stick save the markets with their accommodations? I don't know, but I'm sure that theory is going to be well and truly tested as we move forward in time, and people lose faith in central banks in general and their Wizard of Oz powers, where you don't want to look behind the curtain and see the little man fiddling with all the gadgets and the money printing buttons that they have back there. So just remember, don't fight the Fed. And to that point, our last fund that we have is our contrarian long short all weather fund. So this is a fund that is designed to do the opposite of the markets, i.e. contrarian. It is looking to short the markets, especially at bubblicious territories and disconnects from economic fundamentals. And of course, it did great in the March crash of 2020. Of course, since then, markets have been a one-way street of central bank manipulation. The S&P itself continued to rocket higher all the way up here, even though the broad indexes turned and did nothing over a good 2-year period right here, I guess, from that early 20. Well, I guess that's 1 year period, but regardless, the point of what I'm bringing here is buying stocks at all-time lows is the same as shorting the markets at all-time highs, right? It is simply looking for a change in direction of the overall market flows. So hence, shorting a market at these levels, as the markets do roll over and drop into a recession, depression, then that's when the long short fund will have its opportunity to make hay while the sun shines again. So hence, looking at shorting the markets at all-time lows, it's the same as buying this fund. Sorry, shorting markets at all-time highs, same as buying this fund at all-time lows. Not recommending that. I'm just simply explaining the valuations, the construct of the different funds, and where the opportunities may lie, depending on where people's belief systems are as far as where the opportunities are moving forward. But I'm really looking forward to seeing what this fund does as these markets do roll over and give up the ghost finally once again. So that's our presentation and take on where things stand right now, and a quick little synopsis. It's been a little quicker than what some of our other more longer, drawn out presentations have been, but until something changes, there's really not that much to talk about. So that's where we stand. I think that this coming year is going to provide a lot of changes. Inflation, high, raising interest rates, balance sheet runoff, and obviously problems for the economy. And so remember, there's an old saying: the quickest way to fix an inflation problem is with a recession. So will the central bank actually want to engineer a recession and hurt your average people to try and get inflation under control? Time will tell. We'll find out. All my contact information is here: cell phone, my email, and of course the website where you can see the fund models anytime, because we do update those on a weekly basis. So feel free to reach out with any questions or concerns, or you want us to take a look at what you're currently doing, and or if you just you're interested in what we do and you'd like to come over and join us, the door is open and we're here to help. All right, take care, everyone, and we'll see you with the next update.